Alright, guys, let's talk about the dollar today. And yes, it's still the world reserve currency. But there's a big reason why the global economy is moving away from it. And it's important we look at this through the lens of global trade, especially during Trump's tariff war. What is the role of the reserve currency today? It's supposed to be a unit of trade and account that is stable. But the chart tells us a horrific story, especially if you are holders of dollars. As an exporter, do you really want to hold greenbacks? It's risky and might be a very expensive lesson. Now, since the start of 2025, the dollar is down by almost 10%, and this is serious business. That means your margins are getting eaten away. Your profit could turn into a loss and get you into the red. And that's why local currency trade is going through the roof. Yes, China is spearheading the de-dollarization move. There's no denying that as trade with Beijing increases, the greenback is getting clobbered, and is a direct consequence of the trade war. Now, punishing the world has consequences. The world is effectively forced into a state of de-dollarization, which is exactly what Bessent wants to avoid. Now, year to date, China's overall exports jumped by 6.1%. That's a massive increase when global trade is slowing down, especially with the US. The trade surplus also reached an incredible $683 billion, 32% higher than a year earlier. Now, one can imagine the amount of trade being done in bilateral currencies. China will be more than happy to accept their own RMB or anything else outside the dollar, really. But here's the problem for Bessent. The US is a hyper financialized economy where the higher the rates go, the closer we get towards an economic implosion. Bankruptcies for big companies are already at an all-time high, and it kind of makes sense here. Input costs are soaring higher, something that Bessent can't control. We shouldn't believe the story that Washington is trying to sell us, the idea that exporters are absorbing the bulk of the tariffs. In reality, it's just not happening. US wholesale inflation rose by the most in 3 years. As predicted, the tariff war is beginning to reverse the inflation narrative we were sold. Margins across the board jumped by 2% in a single month. Producer price index is also way higher than 3%. Higher prices are working its way through the system and companies are trapped. There's no way to survive without passing the tariffs down to the consumer. Now, how bad can this go? Well, the effective tariff rate is now around 16%. So this 2% jump monthly in prices could repeat for a few more quarters at the very least. And for Bessent, this is horrific news. He can't control private companies, he can't stop Trump's trade war. So the only lever left is to sacrifice the dollar itself and screw all holders of the reserve currency. And let's go through the smoke screen he's trying to sell the world. Apparently, the Chinese are not interested, somehow they're not interested in making money. They will eat the tariffs because selling in the US is just too attractive.
What if the producer in the other country has lowered their price to 10, 15, 20% so that there is no price change with the tariff? And China does not have the same profit objective that other Western democracies do. And my view has been that they would continue to eat the tariffs. They are doing that. So I think what we've seen is likely to continue happening.
Now, it's the same thing he said about Brazil and other exporters a week ago. Same old story, even in August. But if that's the case, why are producer prices higher, climbing, and inflation creeping up? We have reached a point where trying to deny reality is getting quite pitiful. And this is the biggest tell that the system is not just breaking, we are on the brink of a total breakdown. Now, Bessent is now calling, or rather demanding, the Federal Reserve to cut rates by incredible 175 basis points. And this will drop us even way below 3%, which will be a dramatic shock to the system. Now, I guess you realize the US economy is quite screwed. The job revision of 250,000 down just highlighted how crappy the situation really is. Cutting interest rates is perhaps the only mechanism left to stabilize the economy. Now, we are really in emergency mode, and we need to understand the mechanism of how lower interest rates affects the strength of the dollar. Now, some people might say lowering rates will strengthen the US economy, it will allow companies to expand operations and stay afloat. That will float perception for the dollar. But that isn't the case. It's like trying to scoop out water from the ocean with a pail and telling everyone that it makes a difference. The underlying fundamentals are horrific, core of which is the rise in producer prices. Now, feast your eyes on this glorious mess. Core CPI inflation is back above 3%. PPI inflation, which is what producers suffer, is at the hottest level since March 2022, nearly a full percentage jump in a single month. And this is happening while the dollar is already down by at least 9%. So just lowering interest rates without ending the tariff war will pour fuel on the inflation fire. Now, sure, companies will get more access to capital. Maybe consumers can swipe their cards even more. Banks can start giving out more loans, and Wall Street might make a ton of money. But you are just increasing the money supply, the amount of dollars sloshing in the system. But the amount of goods is not rising at the same rate because costs are just so elevated. In other words, you get higher prices. And this is the elephant in the room that Bessent just doesn't want to admit, or maybe it's an outcome he can't afford to admit, or everything will start to collapse. It also doesn't help that his boss, Donald Trump, is telling the world that everything is fine and dandy in the United States.
And now our inflation is down to a perfect number, a beautiful number, hardly any at all. And yet our country is taking in tens of billions of dollars and trillions of dollars, actually trillions of dollars in tariffs. We're taking in billions and even trillions of dollars in tariffs paid by other countries who, frankly, were taking advantage of us for many, many years. And they were doing that to us.
But let's bring things down to reality. Executives in Wall Street, people handling trade settlements are telling us a very different story. The desire to hold and transact in dollars is starting to fall. US importers are asked by their foreign sellers to settle transactions in currencies outside the US dollar. Instead of greenbacks, exporters want their own local currency. And this includes the Chinese RMB, Mexican pesos, and Canadian dollars. Now, one can imagine this will include many of the BRICS nations that still sell goods to US markets, and it makes sense to them. If you get paid in dollars, it might drop again in value, maybe a 10% hit, especially when rates start to get cut aggressively. Now, sure, you can hedge against a currency crash, but that might cost you anywhere from 2 to 3 to 5% of the total value in certain cases. And for many small companies or competitive industries, that is enough to destroy their margins. They could lose money just selling to US consumers, and we aren't being hyperbolic here. And this is why a further dollar devaluation is just so dangerous. It breaks apart the current trading system, it shifts incentives towards either more de-dollarization or trading away from US markets, or maybe both. Here's the potential for massive disruption. Yes, the dollar today drives the majority of global trade. This is in 2020. So much has changed already. The amount of market share that can be lost is simply breathtaking. In the Americas, nearly 100% of trade is done in dollars. In Asia, it's over 70%. For the rest of the world, minus Europe, it's nearly 80%. But as we know, the trade war today is global. It's hitting every continent, every country, including Penguin Island. So there is already a natural anger to shift away from dollar transactions. And when exporters decide to shun dollars, the currency will have to flood back to US markets. And once again, it distorts the entire supply-demand situation. Higher supply of dollars, chasing fewer goods thanks to the tariffs, you get higher inflation. And that's just on the trade front. It's looking like a disaster just waiting to happen. But we have to touch on the investment part, which is going to react badly from the dollar's fall. Now let's take the Ontario Teachers Pension Plan, basically an investment fund. They have cut their dollar exposure by a whopping $51 billion. That's more than 50% down. Yes, tensions with the US definitely has contributed to that. The trade war also isn't doing US assets any favors. Canadian funds are some of the biggest holders of dollar assets like stocks and bonds. So why are they dumping? Simple. The dollar strength is dropping and the returns, especially from treasuries, are dismal at best. When you convert back to the local currency, what's the point? Now imagine this. A 10-year bond pays you 4% interest a year when inflation is already above 3%. But the dollar has already fallen by 10%, and what if it falls again by the same amount? Now you have 5 years wasted sitting on US bonds. you might as well take the money and invest in your local companies. You can buy gold or even buy stocks in Asia. At least the currency risk there is lower, which is something no one would have ever said 10 years back. The dollar is becoming like an emerging market currency. It's the wild, wild west over there. The nightmare scenario is the amount of money that could leave. There's around $80 trillion worth of US assets in the markets today, and it's a combination of equity and bonds. But if the dollar falls by 10% and nothing else changes, it's a net loss. That $80 trillion today will feel like we'll have only $70 trillion of purchasing power tomorrow. Investors will simply pull their positions and run away. And this is the magnitude of the problem. Yes, the dollar falling could in fact help US exports, but it won't be enough to nearly blunt the impact on import prices and an asset run on US markets. Now, Bessent is trying to move the issuance of treasuries to short term bonds up to 1 year notes. But if the dollar continues to fall, organic demand for those could evaporate as well. Even if he forces the Federal Reserve to cut, interest rates could stay stubborn even on the short end of the curve. He's really playing with fire here. And when money leaves dollar assets, where else can it go? Well, some might head to Chinese and Euro bonds. Money might enter those respective stock markets as well. But a good amount will also enter the gold market, which means if rates fall and the dollar tanks, the gold bull market still has a nice tailwind or two left. Now, Goldman points this out quite clearly. When we add in the dollar's current devaluation, the picture gets even more clearer. From January to May, the dollar fell by over 9%. It's even worse today, by the way. During the same period, the reciprocal tariffs triggered an exodus of money into gold. Why? Because the usefulness of dollars plus the devaluation is making US assets less attractive. Now imagine what will happen if rates fall by another 175 basis points. The dollar will be even under more pressure and holders of the currency will balk even more. So will Trump and Scott Bessent get their rate cuts? Now I believe they will. It's just a matter of time, but holders of dollars beware. The end game won't be that great if you just stay in fiat. Best to scout for the exit soon. But let me know what you think. How much more will the dollar get devalued? Is another 10% drop in the cards, or maybe even more? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.